The NASDAQ Composite seeing its worst day since April. Joining us now, Jackie Cavanaugh, portfolio manager at Putnam Investments. Jackie, great to have you with us.
Thank you for having me.
We've seen this rollover in shares of NVIDIA, and that rollover was marked by a day where it saw an outside reversal hit a new high, heavy volume, lows, continued its follow through. Are you concerned about this? I mean, even though we're seeing gains in the pre-market, are you concerned about the weakness in the leadership of the markets?
Yeah, I mean, listen, you guys have talked about this topic a lot in terms of the difference between the equal weight and the regular S&P and the performance that we've seen. We aren't concerned. We are big believers in AI. We're invested in a lot of the themes around AI. But the reality is, if you look at the technology spend, it's a secular growth story that will have cyclicality. We've seen this movie before with storage, with CPUs, with cloud, where the hyperscalers spend a lot in a given period of time, and then it falls off. And so we do think trees don't grow to the sky, that there's an underlying cyclicality to be aware of. But I think it's a really great opportunity underneath all these stocks that have been left behind that we think have really good prospects, really good opportunity in front of them for broadening in the market. And that's what we're looking for.
Part of the broadening, obviously, we need participation of the sectors that haven't necessarily come along. Yesterday, we got a report from Bloomberg saying that the bank capital requirements may actually be a lot less onerous,
yes,
according to a new memo. You used to head the financial services team, I believe,
yes,
as an analyst. And so how impactful will this be going from an increase in capital of proposed 16% to as little as 5% for the banks?
That was a very meaningful article, and that was definitely what drove the financials yesterday afternoon. To the extent that that's true, it's very meaningful. The original proposals out of Basel III and the Fed were just a big challenge for the banks, and it was going to be really hard for them to hit a return that was acceptable to the market. And so I think that bringing that back in is really important and should allow some leadership, but particularly because a lot of those big names now are going to be in a very overcapitalized position because they all started building for Basel III Endgame because the market has seen this movie before. The regulator puts a goal out there of 5 years. The market expects you to be there tomorrow. And so they were building in front of it. So now I think there's an opportunity for some meaningful buybacks. I think tomorrow night with the CCAR DFAST results will be another meaningful catalyst for the banks.
Which banks would you be looking at more closely when those results come out?
Yeah, so we're big investors in Citigroup. We're believers in what Jane is doing. We think she's taking all the right steps to creating transparency, accountability on returns. Stock trades below 0.6 times tangible book. Just get it to 1 times, which is not heroic when your peer group is north of 1.5, and that's a 50-60% return in a mega cap bank. So that's one that we really find very attractive.
What is JP Morgan trading at in terms of book?
On a tangible basis, it's about 1.9.
Yeah, I thought it was 2.
Yeah. So big gap.
Huge gap.
Huge
is that
gap.
Warranted, or is JP Morgan overvalued?
It is. Well, when Jamie says he wouldn't be buying his stock, that's a tell.
Yes.
But is it overvalued? Probably a little bit, but it is a great franchise. And it has structurally, I believe, a higher return profile than Citi. So I don't think you can look at Citi and say, we're playing for 2, but we're certainly playing for 1.
Right. You like Capital One Financial.
We do. Yeah.
Are you concerned about credit turning south?
We are concerned, right? One of the things that we're definitely seeing at Putnam is a K recovery. Everybody talks hard landing, soft landing. It's a K landing. And so on the lower end, we are watching. You're definitely seeing credit card delinquencies rise, but the stock's trading at 7 times. So a lot of that's priced in. And we think this opportunity with Discover is very meaningful for returns perspective and financial. And it's a little bit of like the enemy of my enemy is my friend. I think that there's a lot of question about whether this deal gets through, but I think having a stronger competitor, Visa and MasterCard, is going to be very attractive to the regulators.
Why do you like a KKR or an Apollo in this environment?
The alts are just this path of democratizing alts and getting it into 401ks, getting it into retail investors, we think is really powerful. At Franklin Templeton, which owns Putnam, we are doing a lot of that. We're really bringing alts to the forefront of our product offering. If you think about it, defined benefit plans are 30% plus in alternatives. 401ks are nowhere. They're the same dollars for the same usage and the same maturity. Why aren't there more? And so we do think that is a path the alts are going to travel, where they get into 401ks, where there's a convergence against traditional asset managers, right? You saw KKR just announce a relationship with Capital Group. And so we think this is a long-term secular tailwind that's going to drive these companies. And again, they're not very expensive. Apollo trades at 13 times.
To like all of these financials that you had mentioned, what sort of rate backdrop do you want to see? Do you assume that we've seen the highs and the next move is going to be a cut and it's downward from here?
Yeah, so we actually think we can put the Fed aside for a while. For the past 18 months, there's been all we've talked about is AI and the Fed. But if you think about it, we came into this process, nobody had a 5 handle penciled in for where the Fed was going to go. So there was a massive dislocation between what the market expected and the Fed was going to do. And then the minute we got to 5, everyone priced in 5 cuts in 6 months. I mean, it was just not realistic. Now we're at convergence, right, where the Fed and the market are very simpatico. And so I think for the next 12 months, we can really sort of say, we know what the Fed's going to do, or we're close enough that it's not going to matter, and really focus on the fundamentals. I think as you get to 26, you got to be thoughtful about the Fed again, because they've penciled in a 3 handle for the Fed funds rate. And we just think that it's probably structurally higher than that. And so
do not have to think about the Fed until 2026?
And middle of 2025 would be where I'd put it.
All right. Jackie, you'll see you before then, I'm sure. Jackie Cavanaugh, thank you.